I just want to say right from the start of this video, I'm going to start with something that's kind of scary, if you will. This is comparing economic data from 2007 and 2024. The similarities are wild. Now, I'm not saying we're going to have another 2007 like economy. I actually think that's not going to happen. I think people that are making that bet probably do not understand economics very well. Could we have a recession? Could we have a soft-ish landing where we kind of come close to a recession but don't technically go into one? Yes. 2007 like recession? Yeah, I don't think that is going to happen, okay? But take a look at this. The Fed's first rate cut was September 18th, 2007. Fed's first rate cut, September 18th, 2024. This upcoming week, literally, it was the same day. The unemployment rate in 2007 was 4.7%. Today, it's 4.2%. U.S. inflation rate year over year in September of 2007, 2.5%. Today, 2.5%. U.S. housing starts. September of 2007 was 1.238 million. September of 2024, it's 1.235 million. So almost identical. U.S. leading economic activity. September 2007, 100.4. Today, September 2024, it's at 100.4, the exact same. U.S. existing home sales, September 2007, 4.5 million. Today, 3.95 million. Now, the author of this post says, quote, "This post is not calling for a 2007 crash. I am simply pointing out the intriguing similarities in timing and economic indicators," which, again, it's kind of crazy. Now, in 2007, markets actually did rally upon the first Fed cut, at least initially. But then it obviously went bad quickly. And I think this is the biggest question that people have for this upcoming week. Are we going to have a sell the news event in markets, or are we going to have markets go higher? Now, there is so many differences from the internal aspect of our markets between 2007 and today. For one, big tech is like 30-40% of the S&P and really controls the markets. Now, 2007, that wasn't the case, okay? So when the Fed cut rates, yes, you can see cyclicals and value and dividends and consumer discretionary, small caps, biopharma, healthcare do well. And that's what happened in 2007. But those areas had a larger concentration of market cap weighting in the S&P, so the S&P went higher. This time around, big tech will probably fall when the Fed cuts rates. Because if we do have a higher chance of a soft landing, you don't want to own big tech. As big tech's, interest on their cash starts to fall, probably don't want to own big tech. And when cutting rates boost consumer activity, that doesn't really help big tech. That doesn't help Microsoft. That doesn't help Google. That doesn't help Meta. That could help Nvidia, but at this point, is that really going to boost demand for Nvidia? Probably not. So for a lot of reasons, big tech will probably not do well or as well as the rest of the markets upon the first cut. So I actually think the S&P is a bad way to look at our markets as a barometer of how good or bad things are. Like what we seen on Friday will probably happen again if the markets have a positive reaction to this upcoming Wednesday's Fed rate cut. The Russell's going to outperform massive. The Russell is up 2.5% on Friday. The NASDAQ up 0.65%. It still did good. S&P up 0.54%. Still did good. But again, not nearly to the same extent as the Russell. Even the Dow outperformed the NASDAQ and the S&P. Now, again, value, dividends, cyclicals, consumer discretionary, right? Small caps, biopharma. These are going to be the areas that benefit the most from Fed cuts. They are also the areas that are trading at big discounts, right? All of those areas are not in a good place. And a lot of that was because of the concentration in big tech, the presumed, recession trade that has been taking place over the past 18 months. Well, if we get a positive reaction to the first Fed cut on Wednesday, which I think is about 30-35% chance of happening, then I think you could see a very aggressive rally in the sectors that I mentioned. Now, I think there is quite a high chance, 65 to 70% chance, that we do what we did in 2019. And that was we sold the first Fed rate cut. Now, 2019's economy was much the same as ours now. Besides the federal funds rate was a lot lower. It was only 2.5% then. So the Fed was starting a cutting cycle at, much lower rates than where we are today. But economically speaking, the economy was starting to slow in 2019, much the same way as what's happening now, right? Leading indicators of the economy were starting to flash some warning signals, much the same way as we are now. Now, the Fed in 2019 on August 1st started with the 25 basis point cut. Markets within this 4-day period dropped 7%. Now, you had rallied into this Fed cut. So markets were trading at all-time highs into the cut on August 1st, 2019. So you did get a sell the news event. Now, where are markets at today? Well, in fairness, we're not at all-time highs, but we're pretty damn close to all-time highs, less than 1% away from all-time highs. So similarly, could you get a sell the news event? Yes, you could. Now, there are different implications as well this time between a 25 or 50 basis point cut. 2019, we had a 25 basis point cut. Today, or Wednesday, I should say, we could get a 50 basis point cut. The odds of this are split 50-50, and there's probably going to be another leak from NikkeiLeaks coming from the Fed and Jerome Powell soon to really solidify the odds of a 25 or 50 basis point cut. The Fed does not want 50-50 odds of different Fed policy actions heading into Wednesday, okay? That's not what he wants, because that's why they use forward guidance, right? They jawbone the markets into, telling us essentially what they're going to do next. And in recent history, we have not been 50-50 for a different policy action from the Fed, 50% pricing in 25, 50% pricing in 50, just days before the Fed meeting or heading into that meeting. That is not a surprise you want to give the markets. And, the odds of a 50 basis point cut went from 14% on Thursday to 52% or so on Friday, just within 24 hours, based on a story from Nick Timiraos. Like, the Fed's either going to have Nick Timiraos put out another story, or the Fed already knows retail sales is going to come in on the light side. That's the only other data point or catalyst that will move the Fed funds futures markets heading into Wednesday, okay? Tomorrow, let's start there. You have New York Empire State Manufacturing Index. That's not going to be important for markets. It's not going to move Fed fund futures markets. Tuesday, you have retail sales month over month. Last month, you came in at 1% positive. You're expecting 0.2%. That's still strong if last month was 1% and you're looking at a month over month barometer, okay? So if this were to come in negative, that's a bigger problem. That is going to boost the odds of a 50 basis point cut. If we don't get an article from Nick Timiraos, in other words, that pushes the odds in one direction or the other for Fed policy, then you're probably going to get a retail sales number that comes in either really good or really bad. Because again, the Fed does not want 50-50 pricing for either a 25 or 50 basis point cut heading into the Fed meeting. With that, you could surprise the markets, catch markets off guard, which markets normally do not like to be caught off guards. Thus, you would dramatically raise the odds of a sell the news event in markets. Again, with that said, last week, the S&P added $1.8 trillion in market cap, posting again its best week of 2024. The week prior was the worst week of 2024, and we are seasonally heading into the worst 2-week period, the second half of September, for markets as well. It's being reported that Deutsche Bank has increased its year-end 2024 target for the S&P 500 index to 5,750 from 5,500, driven by continued robust corporate performance and strong investor demand. But then again, the Saudi central bank is caught secretly buying 160 tons of gold in Switzerland. So what's really going on? It's really hard to say. We do have a big week for central banks, though. You have the Fed on Wednesday. You have the Bank of China on Wednesday. You have Brazil on Wednesday. You have Indonesia and all these other Indo-Pacific regions that are on Wednesday. On Thursday, you have Norway, Bank of England, you have Ukraine, you have Turkey, some European countries. And on Friday, you have the Bank of Japan, which the Bank of Japan is the most important alongside the Fed at this point, okay? Because the carry trade is I'm sure you guys already know by now, but it's borrowing in yen, buying assets in other, markets for really, really cheap. Let's just boil it down to that. Well, as the Fed starts to cut rates and the Bank of Japan potentially raises rates, that is bad for the carry trade, okay? Question is, has that carry trade been unwound enough to no longer be that huge selling force in markets that we've seen in August? I don't think we know until the Fed actually cuts rates, right? That is the other side of why you could theoretically see a sell the news event as well in markets, because the rest of that carry trade might get unwound quickly if you have a 50 basis point cut. Now, with that said, Carl over on X says the U.S. is headed for a soft landing as the economy expands while inflation drifts back to the Federal Reserve's 2% target, according to projections from economists polled by the Financial Times. And again, whether or not we have a soft landing or hard landing is irrelevant. We're not going to truly know if we're avoiding a recession this cycle, at least until probably the end of 2025, right? Like, when the Fed is at neutral or below neutral for the federal funds rate. I think it's far too soon to declare a soft landing. And when Wall Street is so convinced of a soft landing, that means there's risk. There's risk that retail sales comes in really bad and people have to start pricing in. Hey, what does this mean for the soft landing? Does this mean there's greater odds of a recession now, right? So I think when the consensus is so skewed towards one direction or one side, it does heighten the risk of a disappointment, much the same way as if the markets today were all pricing in a hard landing. Then I would be bullish. Then I would be much more bullish than I am today, because everyone's expecting a hard landing. Then odds are markets can be surprised to the upside. At this point, it's going to be really hard to, in a material way, surprise to the upside. Like, everyone's pricing in a soft landing already. You also have a Berkshire Hathaway monster insider trading alert. This individual vice chairman of insurance at Berkshire dumped 55% of its total holdings in the company for $139 million. This is the largest sale in nearly 40 years since joining the company. This got a lot of headlines over the past, 24-ish hours or so. And there can be a lot of reasons why people sell a stock, but it doesn't look great heading into the first Fed cut that insurance companies, or this guy that runs the insurance division over at Berkshire, is selling a bunch of stock. So let's long story short this, okay? We're probably going to get another article or news leak from NikiLeaks coming here over the next 24 hours or so, 24 to 36 hours. Great. That's probably going to solidify the 50 basis point cut. If we don't get that, then the retail sales will ultimately determine whether we get 25 or 50 basis points. Now, whether or not the markets sell the news or not can depend on a multivariate different faction of events. Whether the Fed is dovish or hawkish around the economy, whether we get 25 or 50 basis points will all influence that. I think the odds are that we do get a sell the news event because of how markets have rallied back. We're not really pricing in much risk to equities, and big tech, after all, does not benefit from the Fed cutting rates. So from that standpoint, you could easily get a sell the news event. Now, if we don't get a sell the news event, markets will do well. Cyclical, small caps, dividends, value, interest rate sensitive, call it small caps, indebted companies. Those will be the ones that will benefit the most. Exactly, precisely the same areas of the markets that did well on Friday, which was exactly those sectors that I just mentioned. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.